All right, guys, taking a quick look then at today's incoming US economic data. We, of course, have the US GDP quarter two advance reading. Now, for those of you who are not familiar with the GDP, the way that it is released, we get the quarterly data for the prior quarter, i.e., quarter two. The first reading of that, we get that at the end of the first month in the following quarter. So we are currently in quarter three, of course. We are nearing the end of the first month in quarter three, which means that the data we get today is actually the quarter two data, the first look at quarter two growth data. So that's what we mean by it's normally lagging. It's a lagging coincident indicator, if you want to put it that way. It's an indicator that yes, it should move alongside the economy, but it normally shows us what we already know because we've already seen the PMI data points, we've already seen all the other growth metrics, the forward-looking metrics, the other coincident indicators by the time that we get the GDP data. So just keep that in the back of our minds. The reason why it's going to be more important today, though, despite the fact that it's more lagging data, we will explain that in a second. The other one that we'll be watching closely, of course, is the US jobless claims, which I think could actually be even more interesting than the GDP data. Now, as always, whenever we approach economic data points or risk events, central bank events, whatever it is we want to trade, we always approach it with a three-step analysis process, meaning that we look at the baseline. What's the context of the trade or the context of these releases? Will they matter? Won't they matter? What's the baseline expectations going into it? What will really surprise the markets, i.e., what needs to happen to provide us with the best, highest probability tradable opportunity? And then how does that change the bigger picture? The reason why that's important is it tells us whether it's going to be good for a short-term trade or a medium-term trade, etc. So if we take a look at a little bit more detailed view of how we do a three-step analysis process, we start with the basic scenario, right? What is the current scenario going into this GDP print, going into the initial jobless claims data? Well, the scenario, I think we need to take a step back, apart from the FOMC, and look at what happened over the course of the last couple of weeks or so based on the growth data we had, but more specifically, the dollar's reaction, the market's reaction to that flash PMI data we had on Friday. Now, even though we've broadly speaking, for the majority of this year, seen the dollar trading more as a safe haven, having that counter-cyclical reaction to economic data. A couple of weeks ago, we started to see some of those cracks showing up where the dollar started to trade more cyclical. Then it started to trade a little bit more counter-cyclical again. And now with that PMI data, that was the first real big cyclical reaction in the dollar that we've had in quite some time. Cyclical meaning that bad data was bad and good data was good. If it's trading as a safe haven, of course, you expect a counter-cyclical reaction where bad data is good and good data is bad. So that PMI data was really, I think that teed us up quite nicely going into the FOMC. That was a big cyclical reaction from the dollar, quite a telling one where we thought, as we explained last week on Friday, that it showed us that the growth penny was starting to drop. Right, there was the market was starting to pay more attention. Growth was getting more traction compared to the inflation narrative. Now, of course, that takes us to the FOMC last night, where even though they are still going to hike rates, even though they are still hawkish because they're expecting to hike rates quite aggressively, and they have already hiked rates aggressively this year, they did take a less hawkish stance by basically removing their forward guidance, taking a more data-dependent stance based on the recent growth data that we've seen. And that means that the incoming data will be absolutely key for the US dollar because now the Fed has basically given the markets the permission to start looking at the data more cyclically when it comes to the US dollar again. Bad data being bad, good data being good. Like we saw with Friday's PMIs, that means that any incoming growth data, inflation data, and especially labor market data out of the US will be very, very important for the market's assessment of how aggressive, how quick to the end of the cycle will we be getting for the Fed right now. So that brings us to the incoming data today. That sets the tone, that sets the scenario. We have US quarter two GDP and initial jobless claim. So what's the baseline, right? The baseline is, apart from the expectations that we'll look at just now, the baseline is the Fed delivered a less hawkish press conference last night, acknowledging growth concerns and advocating data dependence. That means that incoming data will be very important, and we expect the dollar to have a clearer cyclical reaction function to the incoming data from here. i.e., negative data, bad, good data, good for the dollar. Right now, if we take a look at the expectations going into it, let's look at the actual expectations. Looking at the quarter over quarter, markets are expecting a positive print, which is the first interesting thing to note. Despite all of the concerns, despite all of the data we've had recently, markets are, consensus at least, is still looking for a positive print. But look at the massively wide forecast distribution. The market is basically, they're aiming at a dartboard right now and just throwing it, saying that, okay, between 2 and -2, right? That doesn't really give us something to work with. It does, however, tell us what will really surprise the markets. Keep in mind that the minimum and the maximum isn't a consensus minimum and maximum. This is the actual minimum number that an analyst somewhere has provided and the absolute maximum number that an analyst somewhere has provided. So printing below -2% will be the most negative data point out of all of the analysts that was surveyed for this particular data point. So um, consensus is expecting 0.5, so is expecting a positive print. But keep in mind, we've had a lot of negative data recently. Even the Fed GDP now is tracking at -1.2%. So that already means that the markets will need something sizable, something really material to surprise on this growth print today. Yes, there's going to be a lot of emotional reactions to it, because if we do get a negative print, it'll officially put us in a technical recession, which is 2 quarters of back-to-back GDP contraction. So a print into negative territory can already trigger some downside in the dollar. But again, it's baked in my opinion. It's already expected right now based on what we've seen with the GDP now data. I think if we want something tradable, something really punchy that we can jump into, scalp to the downside and get out, we need to see something close to or below that -2% mark. Now, apart from that, what about the initial claims data? Now, we've been looking at jobs data so closely over the past couple of weeks, especially the initial claims data. Remember, your NFP is a very lagging report. Labor market in itself, labor data is very lagging. Initial claims, though, is uh, the most timely jobs data that we get. And we've been seeing that trending in the wrong direction for a couple of weeks now, right? It's not just the last 2 or 3 weeks or so. We've been seeing that trend develop from April already. We've got April, we've got May, we've got June. And what makes this more interesting is that we heard Fed Powell specifically talk about this last night, saying that they've noticed the upside momentum in jobless claims. What he did say, though, is that they're not sure whether this is just seasonality based, or whether it's an actual deterioration, a degradation in the labor market. I think personally it's a degradation, because if it's seasonal, 3 months in a row, seasonality, yes, it's important, but geez, that's a lot of seasonal that's a lot of seasonal negativity for something that gets released on a weekly basis. So jobless claims will be very important. If this comes in again above the market's maximum expectation at 260, it's not just the absolute number that's important. That alone will be good for a dollar short, but it's the trend that matters. Anything above expectations or anything that sees that trend continue in the wrong direction, which is upwards, should be a negative for the US dollar. So that again brings us back to our second step, which is the surprise. So what will surprise the markets? Again, because there's a lot of hype about the print, we would need to see something close to or below that -2.1%. And for the initial claims data, the trend is the bigger focus than the print itself, but a print above 260 should be enough to get markets jittery, since Fed Powell explicitly mentioned that recent upward momentum. So what does this mean for the bigger picture? Well, a big surprise miss in both the GDP and the claims should give further reason for the markets to continue trading the dollar lower in the short term, in line with that negative sentiment from last night's post-FOMC. It also means that a miss is obviously the preferred trade right now. Based on that bigger picture view, we don't want to be trading medium-term positions. We just want to be taking short-term positions against the dollar bull trend. Short-term positions in line with a miss. If we get a mixed print, meaning that positive GDP and negative labor, or positive labor and negative GDP, it's probably not going to be enough to get us excited about a print. We want that clear, obvious, no-brainer trade, big miss in GDP, big miss in claims, and giving us an opportunity to sell something like dollar yen, or potentially looking at long opportunities in something like the Kiwi dollar as scalp opportunities. Why the Kiwi? Just because it's been trading fairly solid in today's session. It's leading the pack to the upside, and it does have a catalyst behind it today because we had some really solid, well, better than expected at least, business confidence data coming out of New Zealand, something that has been a key focus point for market participants in the last couple of weeks. So how can we look at these events? How can we look at the pair then? Something like dollar yen. Well, we do have the implied volatility weekly low coming in at 134 psychological. We've got that 135 psychological level as well. Let's just see where we're tracking in terms of our pivots because we've already had quite a big momentum move. So on any miss, big miss in GDP and initial claims, obviously at market opportunities looks attractive. And on those types of moves, you could be looking at either the 135, the 134.50, or that 134 to the downside as key opportunities to limit risk, reduce risk in the trade, or potentially take some profit off the table. In terms of the Kiwi versus the US dollar, let's just get the pivot up here for a second. We've got some very key resistance here at that 63 psychological level. We've got the R1 pivot. We've got the high going back to the 22nd of July. So that's going to be a tough nut to crack. But if we are able to take an at market entry and crack above that level, we could be targeting 63.50. It's the implied volatility high of the week. It's the highest going back to the 21st as well as the 16th of June. And again, we have that positive sentiment behind us. So that looks like a possible good target to aim for on any type of big miss that we get in something like that US GDP and initial claims data. So that's just a quick preview as well as a trade plan. Any questions on this though or more details, don't hesitate to let us know.